you're always going to be looking to refine your entries. So yeah, the bigger time frame. So this is the 4 hour. I'll switch this over. Okay. This is a lot clearer. So this is the 4 hour. Each of these high time frame candles is 1 hour. So 4 hours. And then if I was to switch over to, yeah, this would be the day. So remember what I've said multiple times. The best sells are going to be above the open. The best buys tend to be below. So if you're looking for a counter trend sort of move, a sell, or if it's just continuation of the daily, the best sells are going to be above the open. So in this area here, especially when you have a high time frame area of interest, this impulse down is just added confirmation that we're moving bearish on lower time frames. So that's a daily. 4 hour, you have added confirmation of that 4 hour close bearish. A type 1, you're looking for it to create a top wick in that first half of that candle, which you did just to fill in this body. So that'd be a level around there, taking a sell with DXY moving bullish. That's how you refine and like get really nice timing. Because my entry was like with volume pushing. And you can take a sell when you have something like this where you make a low, break a high. You can take like a sell if you want to be a bit riskier on the entry with the idea that it's going to make a type 3 or push through. I took profit around here because I thought it was going to have a pullback, but you just went straight through. Okay. So a lot of people do the analysis, like areas of interest, all that sort of stuff. So you have a general zone here. A lot of people do that analysis and then they wait, or they're looking at the charts for the next hour, 30 minutes, and then they might take a trade, a buy, because they see this break or this low, and they might completely forget about the overall direction. So if you struggle to follow your plan, struggle to follow your overall bias for the day, you initially go into a session saying that you're going to do something, then you change it, which is what I used to do a lot. I was not following my initial analysis for the day. It's because you're looking at the charts too much. So we're covering routine as well. The thing that I like to do, I'd like to draw my areas of interest first, get my general feeling, areas of interest, then get my general feeling about the overall direction. If we're up high and we've had a shift, I'm not then looking at that pullback. I know if I'm going to enter on that pullback, I'm going to wait for it to come into either a low or a high. If it's a bigger break, it's going to most likely be that low. So what I'll do, I would set an alert just below that low, and then stop looking at the charts. If it keeps going and I don't get alerted, that's a good thing, because I've avoided wasting my time. There's going to be no setup anyway. If I kept on staring the charts, I would have forced an entry, forced a trade. I would have seen things that weren't there. So if it does tap you in, then you can start looking at for an entry. If it's a bigger shift like it was today, you can look for refinement, look for timing. If you're not sure as well, if it's a big pullback, this is where I look at DXY. So it can be DXY like breaking a high or like having a push or volume come in for a sell. So use alerts. All of you, like, there's no reason not to use alerts. Sometimes I forget to use them. But if you're like in structure where like you've had a big shift and you're just waiting now, or price has gone without you, there's no reason not to set an alert and just wait. Go do something else and come back later. It gives you a bit of a reset. But also be aware that your mind is incredibly biased and untrustworthy. There's a thing called availability bias and recency bias. So information that is more available, more recent, you will give more weight to than other information. So you might start off on the high time frames, drop down into 1 minute, and then just be looking at the 1 minute for the next 30 minutes or that hour. And you might completely forget about the overall structure bias direction. And then this is why you're like, oh, well, I like over trading, or I'm taking shitty trades. Why do I keep on forcing these shitty trades? It's because you've been looking at the 1 minute chart for like 30 minutes. You have availability bias, recency bias. So I tend to look at the charts as little as possible, mostly, and set alerts at just before areas of interest. It can be just before areas of interest. It can be before highs and lows. If you're currently ranging and price is looking kind of ugly, you can set an alert at a high or a low. Wait for it to break that low, not to even like take a sell. If like overall direction is like bullish, you can wait for it to like break a low, have like a shift, and have a push. So I think everyone would benefit for setting alerts, not just for entries, but for managing trades as well. Let's just take one of the most common entry models, the type 3 shift here. So you might have an alert at the previous low, might get tagged in. You might have like a 1 minute candle close bearish. Like you can have like confirmations within confirmations within confirmations. And then you might have enter on that pullback of the top wick being formed in that 1 minute candle, which is what I like to do. If we look at today, exactly the same on the 4 hour. You had the 1 minute candle close bearish, create that top wick, looking to take a sell as well. Candle behavior happens on the 1 minute, the exact same as any other time frame. Is 11 AM to 9 AM candle open. And which time? So this is UTC plus 10. That's 11 AM UTC plus 10. Here. So using that 1 minute candle behavior for a more refined entry. Enter on the top being created as well. Stop above the high, targeting previous AOI's low time frame. Yeah. So what would I now do here then? So I see a lot of people moving stop losses to break even. There is really no real reason. I've never found a good reason to move your stop loss to break even, unfortunately. Because like if you're doing that, you're trading your account balance most likely and not actual market structure. Even if I get the perfect entry and it's like maybe a pip to that high, I'm not going to move it to break even based off how it trades. So the reason stop loss is above a high, because if you break a low, break a high, that's the inverse of the shift that you look for. So it invalidates your trade. Always put your stop loss where it invalidates your setup, your idea. If it breaks a low here, that's when I can look to manage my trade. But I've taken a trade stop above a high, and then I'd put an alert here above the low, above the high. So I'm only gonna manage my trade if it breaks this low, but I just want to be notified if it breaks this high. So I'm either on my phone doing something else. I'm not, most of the time, depending on volume. If it's a longer time frame trade, I'm using these alerts. When I'm scalping really low time frame moves and volume, then it's less of this. But most of you are trading a longer duration than me, so utilize alerts. The more you look at like it going back and forth, the more anxious you're going to get. If any of you struggle with holding trades, it's most likely because you're actively looking at the charts too much whilst you're in a trade. Go do something else. So if we break a low and it's nice volume, I'm going to look to move my stop loss to above a previous high, because if we break a low, break a high, inverse of what I look for, likely to move bullish. If we break a low, break a high, then continue. Unlucky. Another setup I can look to enter on, and these tend to work out really nice. You might even have this as well, where you think you have the shift, but it's actually not the actual shift. It comes a bit later. Entering on after you get stopped out and then entering again, perfectly fine. Those tend to work out really nice as well. But trailing my stop at that high, I never move it to break even, because there's no reason to. If I do that, I'm just trading my account balance, not actual market structure. So candle flips. If volume is pushing really nicely bearish, I might add to my winner. If we have nice volume, let's say we have a high time frame candle close. So maybe this is like a 30-minute candle has closed bearish, and like we have a new candle opening around here, and we have a pullback of this structure to like this previous low here. This is when I might look to add to a winning position with a stop loss maybe above that high. Looking for that candle to flip and push bearish. So technically, if I'm using the same position sizing, I've doubled my volume behind this move, bearish, but my risk is maybe around 1.5 times, maybe even a bit lower. That's how you can like get lots of volume behind a move without necessarily higher risk. So this is how you can add if you're expecting to it continue to move bearish. That's what I would look to do. I can add to winning trades more. It's just that I like to be in and out. This is kind of like a more defined way. Have a play around with it. See how you like to trade. This is the simplest, easiest way to do it. Entering on a pullback. If you break a low with nice volume. If it's with a high time frame, like this could still be another type 2. Entering on that top wick being created counter behavior for like added confluence. If DXY is still looking nice and moving bullish with lots of volume, that's when I would look to add to a position. This is like adding to positions is actually like not, I don't always do it. It's rare. If it's kind of like, even if it's kind of like I've entered early and we have a shift here, and it's like this is like a high time frame candle close. We're creating a new high time frame candle on the 15-minute, which is like what happened recently on a trade. You can look at Tom's charts. There's a trade where I added to a sell recently. I added it even though it was like maybe around like this general area. It was like pretty close together, these cells. Like I think my cell was here and then my new cell was like here. It's just because this 15-minute candle like closed bearish, and you had a new one creating a top wick. So it's like added confluence. Already had a shift with high time frame candles closing into my favor, so I could add another sell for continuation. But ideally, the best is just trading your stop loss, adding to your winners when it's clearly breaking lows, it's moving with volume nice and cleanly, and you have high time frame candles closing in your favor, creating a top wick or bottom wick in that first half to enter on. So basic candle behavior. If you're trading with a 4-hour type 1 or type 2, you can look to hold that trade longer on average. If it's with like higher time frame structure, you can also look to hold that trade longer. Overall wise, as always, it's like not one or two things. You have to stack lots of things in your favor, probabilities and all that sort of stuff. All the calls are recorded and uploaded to Warp. If you have the discipline, and if you've never had an issue with adding to losing positions, or if you've never had an issue with like not like with like managing trades or like exiting as soon as like you think it's wrong, you can have a manual stop loss. There's pros and cons. If it closes below, yeah, you'll avoid getting wicked out sometimes, but other times you might have it go with volume, and it might end up in a bigger loss. There's kind of pros and cons. It's just whatever resonates with you more. There's like infinite ways you can manage. I tend to focus on what's the simplest and easiest to execute. Manual SL stop loss might be optimal for certain people, but if it's more complex, it's not really worth the trade-off. I would probably like, that's what I like. If you might get like a 5% increase in your profitability, but it doubles the complexity, that's not worth it for me. Like I could have a lot bigger wins if I added and held more, but if it makes it harder to execute, a lot harder to execute, is the trade-off actually worth it? Not really. All good. So like if you like try it out, the fastest way to find out if something works is to try it out. Yes, it's fun to like theory craft, make up all these things and like test out all these things in the head, but the quickest way is just to experiment. Okay, it should be working. Interesting. Not sure why that isn't working. Yeah, output. It's so we're using the stage this time, so maybe it's something to do with like stage settings on Discord that might affect it. But so yeah. So if you're not sure whether to wait for a higher time frame candle close or not, most of the time it's better. If you're like taking a break in retest, or if it's a breakout, I think it's always better to wait for a high time frame candle to close to enter on the pullback. If it's a lower time frame like type 3 shift, like low time frame structure shift, if it's like a smaller shift, you don't have to wait for a high time frame candle close. If you want more information, if I can find it, I uploaded a video about when to wait for a high time frame candle to close, if I actually am able to find it. This here. Okay. If you want to know when to wait for a high time frame candle to close, click on that. It will take you here. There's a video covering that. So if it's a type 1 or type 2, and you're just taking it off like a break and retest or like a pullback, wait for the high time frame candle to close. If it's a lower time frame type 3 shift, so today was a bit bigger of a shift here, where like just like if you just look pip wise, like that's what, 70 pips, and this is like the shift's duration is like almost 3 hours. If you have like a smaller time frame like shift to structure in like here, you don't have to wait for high time frame candle to close. It might be a little bit better if it does, but you don't really have to. Okay. So, okay. So yeah, different sessions will have different characteristics. I just like to trade around 4-hour candle opens. I think I've always just had better success doing that. I always felt the most comfortable doing that. So you can trade the 3rd hour of London, which is that 4-hour. I'm not sure about New York, but there's a 4-hour open near like pre-London, near the end of Asia. Every time works. Just do it consistent and learn the characteristics and little frequent like characteristics of it. Yeah, because sessions cycle through. Like recently, Asia has been really high volume. London has been lower volume. That's not going to last forever. You're going to have periods of time where Asia is low volume and London's high volume and trending. But the thing is, you adapt to that session and you trade in a certain way for a period of time. So if it's like low volume, you adapt to small mean reversion, lower targets, you're holding trades for less. But in periods of time like now where it's high volume, in Asia, you can hold trades a bit longer if it's with a 4-hour or high time frame. I like to trade in a way that I can trade every single day, almost regardless of conditions. That's why I have small targets as well. Simpler. I always pretty much go for the simple option as well. Okay, so I kind of went on a bit of a tangent here, but yeah, being mindful about volume volatility of recent sessions, of recent periods of time, and in the current session. Price is likely to continue doing what it has been doing. If it's been high volume, it's likely to continue being high volume. If it's like a little bit low volume, it's likely to continue low volume. Don't expect price to do anything different randomly. Wait for some confirmation as well. So yeah, whenever that, counter behavior, market structure, all that sort of stuff. Okay. Position sizing isn't just about risk management, it's also about psychology. If you struggle with psychology, most likely it's because your position sizing is too big. Because you care too much about the outcome of a trade. The easiest way to fix that is just to decrease your risk to a point where you don't stop caring. What that will be, I can't say because we're all different little snowflakes. But if you're struggling with psychology, it's either because you don't actually have something that works, you don't journal your trades, you don't have a plan, you don't actually have a system, you actually don't know what you're doing. The more clarity you have in the system, the better. Or it might just be because your position sizing is too big and you care too much about the outcome of 1 or 2 trades. Think of risk as a mental weight. The bigger your lot size or percentage size risk, the more weight you're putting on a bar. And we all have different strengths and weaknesses there. Some are more risk taking, some are more fearful. Best way to find out what size works for you is to experiment. That's the quickest way with most things. Stop loss should be placed at a point in market structure where it invalidates your setup. Very easy way in taking shifts of structure is placing it behind a low or a high. If it does that, it's a shift against you. You're consistent with how you manage, with how you enter. Consistency and simplicity are the keys kind of there. Keep it like, it's easier to just like be a little bit more mechanical in the beginning. As you learn, as you like build intuition, build learning experience, then you can kind of experiment with different things. But focus on finding something that works concretely, and you can only find it you can only know that something works if you like journal the trades in detail. So I'm going to keep saying that. If you don't, like, if you're here and you don't journal your trades, I pray for you. But all of you should be in as much detail as possible. You should be spending more time preparing, more time working on your plan, working on your journal, than actually trading. Preparation. What is it? I think Alex Hormozy said this. Like, any amount of time you spend in preparation is worth like 10 times that in the execution or post. So preparation is kind of like, it's a leverage activity. The more time you spend on your journal, plan, having clarity, teaching others is preparation as well. So group discussion, feedback, like that's all preparation. It's high quality practice. So you should be spending more time doing that than mindlessly trading. Because I spend a lot of time mindlessly trading. It's good for intuition, but it doesn't make you profitable. You need both, but most people have enough experience trading, but not enough preparation. Okay, so stop loss, trailing stops, went through that. I do it just off basic structure because it's simple, easy. I just trail it off highs and lows, and I also use DXY to manage trades as well. It's not as simple though as, so I kind of had like a question about this recently. So like if I'm like taking just a like classic break and retest, like a sell on like gold, and DXY is like moving bullish, and they're like kind of aligning. If I see this happen on DXY and it starts to move bearish, I'll wait to look at how gold reacts to that on DXY. Do we immediately start pushing bullish? Does volume start to decrease, or does it continue moving? I won't immediately. I'll wait to see how it reacts, like how it's like correlating with DXY. Because as you know, these two aren't perfectly correlated. But out of all of your guys' journals that I've reviewed, every single one, if they use correlation of DXY, it increases their win rate by like 10 to 20%. For me, it increases it around 20%. So looking like using that behavior in between, like how they're relating to each other on that certain day, because different days they're going to react differently to each other. It's just like, this is more intuitive, like how you trade them both. But if volume starts to slow down, if we struggle to break lows, if you might have like a little low time frame shift on DX on gold, and DXY has really pushed bearish, that's when I look to exit. And this is like highly intuitive. You'll get better feel for it with time, and also like ticks as well. So like how like quickly price is moving, or if it has like a push and then it kind of like stalls out a bit, and it's like not really moving, might look to exit, and then it might have like something like that, like if it stalls out. And that's kind of how I get decent trades. So yeah, I'm always looking to take small high volume scalps, entering in one move. This is going to happen. I'm going to exit early. That's the reality. Like you might, like if you did the exact same thing as me, you might get mad at yourself and wish you held, but I'm happy with that win. I stuck to my plan because where other people got greedy and held, I stuck to my plan and focused on simple, consistent trades. I trade in a way that I can consistently execute on every single day. So pretty lucky, or like pretty good exits there. More often than not, around 10% of the time, I'm getting good exits based off that. The small amount of time where I'm wrong or I exit early, I'm okay with that because I know I'm not trying to be perfect, I'm trying to be consistent. A lot of people I see get mad at themselves for these situations, and then when they try to hold and they don't exit and they get stopped out, they say they're too greedy. Don't justify the quality of a decision based off the outcome. Like, and all of you, pretty much most of you do it, like either subconsciously or consciously, or even type it in chat, because I sometimes do it as well. Don't obsess about like having the perfect exit or the perfect outcome. I did this like so many times for years. I did it, and like it just ends to you changing what works, trying to get the perfect exit, get the most amount of optimal profit. You don't need that much of an edge to be profitable. Lots of money comes from lots of leverage, lots of capital, not being insanely profitable. You can always increase that with either risk or capital. So you just need a little bit of an edge. Okay. So I tend to use market orders. Limit orders are also good because if you're entering off a pullback, which most of the models in this is off a pullback, if you want better entries, use limit orders. If you want more confirmation or more probability of like actually entering in that position, use a market order. If you struggle with hesitation, use a limit order. So if you have fear, or if you like, you do your plan, you do all your analysis, you set up to actually take the trade, but then you hesitate, which is what I used to struggle with a lot, was fear, hesitation, all that sort of stuff. Set a limit order at that new high time frame candle close at a point of area where you're expecting it to like create a wick into. So if you like analyzed your area of interest, if you like waited for that 4-hour candle to the new one to open, you just set a limit order at that area of interest, wait for it to be tapped into, maybe placing a stop above previous low structure high, and then it's hard to hesitate when it's a limit order that's putting you in. So yeah, if you're entering with volume, or if you're taking a breakout, a valid entry here would have been, you could have like entered with volume coming in on the flip of this candle. Like, you don't have to enter on the pullback, you can enter on flips. When it's been higher volume, I've done that as well. Adaptive conditions, you can also use stop orders when I first started trading, like 4 or 5 years ago, like 4.5 years ago, I was using stop orders on 5-minute candle flips. And take profit, I put it at the first low time frame of interest because I want like more consistent equity curve or more consistent outputs, a higher win rate, smoother, more confidence, suits my psychology a bit better. Even though most of the time I find higher risk rewards, if they're executed correctly, are more profitable. They're just a bit harder, but I tend to focus on what's simple and easy to do. Why trade only 1 hour of the day if setups may occur throughout the entirety of the day? So this is like, I used to do that. I used to trade 8 hours a day, and I was not profitable. Okay. The thing is, more isn't better. More indicators isn't better. More pairs isn't better. More trades isn't better. It's like you think adding like good things into something, like there's diminishing returns, unfortunately. Exactly the same, like you might eat one chocolate bar, it tastes really nice. Why don't you then eat chocolate bars for the rest of the day? Because diminishing returns will start to make you feel sick. The thing is, you're trying to be like a sniper rifle, not like a machine gun sort of thing. You're trying to focus on quality, not quantity, because like mental capital, think you have like, yeah, you have your financial capital, you have your physical capital, but you also have mental capital. Trading is really like taxing mentally. It takes a lot of willpower, discipline to follow your plan perfectly, to make split-second decisions, lots of focus. So your willpower, your mental energy, your focus is finite, unfortunately. Yes, you can improve it, but your focus is finite. So your decisions in the first half of the day will be a lot better than the later half. So why wouldn't you just focus on the quality decisions in the first half and then just put size behind them? You're saving yourself. It's a lot easier as well. But yeah, that's kind of the main thought process behind that. But you might be like Tom Hugard and you might be able to trade for the whole day. I'm not. For me, one trade a day is a lot. And like, find out what works best for you. I'm not saying you don't like if it works for you, do it. But most people it's really hard. It's a lot easier just to do that, and I'm focused on simplicity. Remember, like, why are most of you trading, or why did I start trading? Yes, it's nice to make money, but the way you make it is more important to me. You're trading to get freedom, to get independence. So I don't want to be dependent or shackled to the markets for 8 hours a day. So freedom. If there's a big shift before Asia, second hour, won't look for a small shift. Yeah, so if the move goes on without you, like if you miss the move, like if I had missed this move here, there's nothing wrong with that. Like that happens a lot. I'll go through yesterday as well, but if you miss the move, a lot of time if it's like big high volume push, you can wait for another entry for a correction of that as well. Maybe for small counter trend scalp, or waiting for continuation. I didn't trade yesterday, even though I could have, but I couldn't really be bothered. That's kind of where you want to be at. Where's my session? There we go. So let's say you missed this like initial move. You could have waited here for a correction of that. So yeah. That's kind of like you're gonna miss moves. But the good thing about this kind of approach is that you're trading like pushes and pulls. If it's a really high volume move, or it just goes on without you, you can take a correction of a little bit of that move all the time. And these all the time are really nice setups. Kind of like here as well. Like you might have missed this move push bearish, but you can take it on that shift here. I started through a small account, grew that, used profits to buy prop firms, compounded the small accounts, and used profits from the prop firms to buy bigger prop firms, and then feed my personal account. So like you funnel it into itself. That's probably the easiest way. If like prop firms are a good way to learn, like because you only have like finite risk on the line. Like you can start off with like a 10k, and it's only like, what is it? It's pretty cheap now. It's a lot more expensive. And like the perceived risk of a 10k, like putting like I don't know, maybe like $89 into a 10k, is a lot like less perceived risk than like putting $1,000 into a small live account. Like if you, depending on the leverage, if you just have like normal like low leverage, or if you have risk manage, it's like going into like 8 to 9% drawdown. Like 8 to 9% drawdown is exactly the same. Like if you go into like 8 or 9% drawdown, you're likely to blow this account and lose all that. It's like kind of like the same sort of like situation. Yeah, personal accounts, like because it's more perceived risk, even though like each individual trade, like if you're taking 1% risk on a 10k, it's like technically it's 10% of that like 89%, because it's like you only have daily drawdowns, max drawdown, all this sort of shit. So this is like kind of can be psychologically easier. It depends. This is easier to trade than this. Personal accounts are easy to trade, like statistically. What is it, like 80% of people don't make money on personal accounts. 99.5% of people don't make money on prop firm accounts. Like the stats behind prop firms, like you'd be shocked. Like it's so like the chance of succeeding in this is so much lower than a personal account. And you have to deal with all the rules and bullshit around that. But you can use both. I found it was better to prove to myself that I was profitable first before trying to make money. So focus on learning, getting better. Then you might find yourself like you shouldn't be like focused on like trying to become profitable as quickly as possible. You should be focused on what you can control, which is learning and getting better each day, for like focusing on getting better at the process. Then you might find yourself a couple months later profitable. Like you might look back and say, oh, okay, I've actually made money every month for the past 3 months. And then, okay, well, I've been profitable for this period of time. I'm going to move on to this. I'm still profitable with that. Keep on going. Not trying to force like white knuckle grip. Trying to get as profitable as quickly as possible. Unfortunately, the harder you try at some things, the harder you chase some things, the faster they'll run away. So how do you combat that? Like I've said this a lot of times, but this isn't just about trading. This is about everything in life. You're not trying to achieve an outcome. You're not trying to, it could be like a test. You're not trying to get an A on a test. It's impossible to get an A on a test. It's impossible to become profitable. It's impossible to blow up on social media. You can't actually achieve it. You can't force it. What you can do, you can study every day, put all your effort into the process, studying as best as you can. And if the questions are good, if you focus all your effort and process onto making the best videos possible, and trying to make videos so they get views, you're trying to focus on providing the most value, getting the best videos. If you just focus on taking the best trades, not trying to win. If you just focus on going on dates and improving your social skills, or going to the gym, improving your aesthetics, improving your mental health, your emotional intelligence, not trying to chase girls, yeah, they run away from you. They can like tell if you're desperate. The markets can tell if you're desperate, and they'll take that money from you. So The more you focus on improving yourself, this is why I say the internal journey is more important than like any external accomplishments. I didn't make that up. Like, what was it? Samurai dude, Miyamoto Musashi, best samurai, made that up. And that kind of means like every time you take a trade, you're being rewarded. It's either from external profits, or if you lose, internal learning. Most of our learning comes through failure. You learn not to touch a hot stove from touching it and burning your hand. So the more comfortable you are with fucking up, failing, making mistakes, the more you'll learn, the quicker. So like, the outcome really doesn't matter, because yes, like you might get the external outcome, but if you don't, you're getting that internal learning. So the only way to find what works is to do what doesn't. So you need to do what doesn't work in order to succeed in certain things. And I found that in sports, in dating, in content, in trading, in everything else. The more you're comfortable with failing and like learning from that failure, because it's only a bad thing if you don't learn from it. So how you like detach, let go of the outcome, have perfect psychology, is to be okay with like failing. Is to focus on learning as the priority, letting go of winning, of the outcome, because the more you are able to delay that, the further you'll go. Everyone successful in life has like failed a lot longer. Well, like, yeah, everyone like further ahead of you has just failed more than you, if that's one way to like simply put it. So detach yourself from the external rewards, and if you like focus just on the learning, long-term results, behavior, all that sort of stuff, it's inevitable. If you just get 1% better every day, it's inevitable that you'll get what you want. So bit of a rant, bit of a tangent there, but that's like kind of the more important thing. Like a strategy, it's limited, but if you can like learn how to fail, learn how to learn like these meta skills, you won't just succeed in trading, you'll succeed in everything in your life. You get the hottest girlfriend, the best relationships, the best career, anything and whatever, anything you want. Like all these like meta skills, that's kind of the thing that matters. And money doesn't make you happy. Like for a lot of people talk to you about that, told you that, and you say yes, but I'd rather be sad in a Lamborghini than in a gutter. But really, do things that you enjoy. Hopefully, like if they make money, you'll still have the same problems. You'll still be you, even if you have a lot of money. And like hedonic adaptation, all that sort of stuff. The only point of money is to buy back your time and freedom, which is what I found. Like that's the whole point. Charlie Munger, one of like the richest men. Charlie Munger, like partner of Warren Buffett. The whole point of him getting a lot of money was to be independent, have freedom to do what he wants, to do what he'd want to do. Yeah. Okay. Sorry for going on tangents here, but yeah. So regularly being aware, reviewing market conditions, fundamental drivers, like that shit that happened last week, I would say, around a bit of a market crash, JPY, perceived global risk. There can be a little bit of a delay, but mostly when global risk tends to be increasing, gold will increase as a hedge against that risk. So it's historically seen as a safe haven against global risk. I like to trail stops because I like to lose less than I initially risked. Most of my losses, you'll see, I lose less than, I don't let it hit my stop loss most of the time. I feel like most of the time you know, before it hits your stop loss that it's going to turn into a loser, like probabilistically wise. Like that's what I always found. Like I knew it was going to hit my stop loss before it did. And if you decrease your position size, everything else will get a lot easier when managing and entering your trades. Yeah, it's good that you closed early, because when you see it's ranging here, you're not. I hate this price action. I hate it when you're not breaking lows and you're not breaking highs. You're just ranging. That's I always exit this early because you're just ranging. I really don't like that when kind of volume's decreasing. So yeah, that's good that you exited that early. And yeah, if you see a high time frame candle move like without a top wick straight in one direction, it's likely to then reverse a bit later on that candle, I find most of the time. So it's not a bad entry. It is a bit low, I guess. Like if you think about like this kind of move down, if you can see this kind of move down, and you're entering on like previous lows, like at that you've had a push, you might have a pullback, and you might have a push again, but you've kind of like entered around like the previous lows, around it being extended. So that's kind of like one of the main things. What it kind of looks like. It's kind of like similar to not like really wanting to look for a buy up here. Like you have being aware where you are and like market structure. Like buys look the most obvious around here, but the best buys are around here. So like buying at highs, like it's likely that it's going to reverse or stop you out. And like if you know like low time frame structure, like it looks like maybe you've taken a sell like around here, it's likely to have like to go through indecision or to reverse. I used to trade the open of Asia session or like a little bit pre-open. And on gold, my win rate wasn't great. I always found on gold, when I was trading after that 4-hour open, my win rate increased a lot. On UCJPY, it was better. I could trade the open, but I just like gold a little bit better. Yeah, so I always close my losses early, pretty much most of the time. Like you'll see in my trades, I close my losses early, or manage them, because like I'm scalping volume. And it's kind of hard to gel while doing that, but Giga Chad. If it's personal account, I tend to use fixed lot sizes. Depends on volume. I might change that. With gold, it's really easy to use lot sizes because it's $10 a pip for one lot. If it's USDJPY, it's like 7.5, and that's a bit more. Trying to calculate that shit. I'm not good at maths. It's very easy on gold because it's like a fixed 10. For prop firms, yeah. So like as well for fix, yeah. Like look at like how big my stop loss would be if it's around like 15 pips. I choose a lot size based off how because volume decrease like is changing day from day. Yeah, like much. It's good that you manage that trade well. Like sometimes I have bad entries and good management. Other times I get good at both. Other times it's bad both. But not the best entry, but you had really good management. So there's always a positive and negative, or like learning to take out of a trade. I don't really have a fixed risk amount. I just take 1 or 2 trades per day. Most likely it's 1. Yeah, I think a lot of people have done like adding in missed trades, adding in why you missed those trades, what reasons for missing that is a good idea for you then to go back and review and learn why that was and look at weaknesses. So that's a good idea. But yeah, so I wake up, have coffee, I might meditate, journal, or I might read. I avoid social media for the first hours of the day. It just makes my day a lot better. I hop on the charts a little bit before that second hour open, post the analysis areas of interest, and then I'll do my areas of interest first. So do like areas of interest. I'll just focus on the ones that like clearly stick out to me the most. Go down. Kind of want to stack areas of interest, so you have like a full hour. You also have like a 30-minute. It's a pretty strong one. It's like stacking that. Go down, look at it. Put my basic sort of stuff. Look at DXY. Look at how that's moving. If it's moving, great reaction to. If it's ranging, not the nicest, but you have a reaction to an area of interest. You have it breaking lows and breaking highs. It's a bit of a shift. So obviously looking for a sell on gold based off that. Then I'd wait where. So I have my direction based off that like structure shift. Overall where we are as well, and areas of interest. So direction, areas of interest. With both that and DXY, then I'll wait for around that new 4 hour to then look for a trade, because that's when volume tends to come in, and I'll be looking at both DXY and gold for an entry. Take an entry, or if it sets up straight away, I'll take it. If it's a good trade, mostly it's just 1 trade per day. And I'm done. Some days I might have more energy, I might feel better, or I feel like I want to, like, or price action is nicer. There's opportunities for more trades, and I might do that as well. But mostly it's just 1 trade per day. Yeah, so for areas of interest, like you'd say, like these kind of like lower time frame AOIs, like you can do if you really wanted to. Like you can always refine a little bit more. And also, like the take profit today was based off like this, like kind of like level low here. That's why I was just like taking that based off. I don't use seconds time frame. I would think about like maybe using like ticks, but like you don't really need to go much lower. Like I was like, you can like each tick of price action, but I can see the exact same thing here by just like looking at like the individual 1 minute candle, like a tick of like a shift, like a tick of like a shift here that would just look like a 1 minute candle closing bearish, maybe like going near breaking below previous low, or like taking like a 1 minute candle type one. You're seeing the exact same shit, just trading like kind of through like a different lens. So you don't really need to look at ticks. Also, as well, less is more. Keep it simple. You don't really need, like, there's already like a lot to focus on, I guess. I can do live trading, but I don't think it'll be beneficial to me. It'll be beneficial to you guys, but having to answer questions or trying to take trades would probably give me a headache because I'm scalping like, most of my moves are like 5-10 minutes. And it's kind of split second decision making. I will be uploading all these indicators, or be sharing them. I've kind of like edited the source code. Yuchen showed me that, like, I didn't even know you could edit source code. That fixed for the Monday sessions, so thank you for that. I've like changed a bunch of indicators, updated these to like, that's what I've been doing most of the day. Yeah, thanks for that. I didn't even know you could do that. So Asia session, so we'll be sharing this as well. And yeah, trading view template, I think it's just black for the background. Like colors wise, it's just gray and gray. I think for some reason I just like the kind of black and white. I don't know. It could be like subconscious. Like blue, like green and red is seen as like good and bad. It's just, I don't know. It's a bit clean, a bit nicer. If any of you guys use white backgrounds, I don't know how you do that with your eyes. It's a lot of different color themes here. Of which indicator? I will be sharing all of them with like the settings will be set like in the source code sort of stuff. So like they'll be default. Yeah. Okay. What's weekly looking like? Yeah, you kind of are at all-time highs again. Global risk is perceived to be higher. You have a bunch of riots in different countries. I think it's like Bangladesh, UK riots. You have the JPY interest rate. There's an interest rate increase, like the big crash last week. It wasn't a big crash, but correction last week. So like when times are volatile, global risk is perceived to be higher. Money will flow out of equities, tend to flow out of equities into safe havens like gold. I don't trade high time frames, so this is kind of useless to me, but a bit of a nice thing to keep in mind as well. And type 4s and type 5s. Yeah, so yeah, I'm still kind of experimenting with them a little bit. It's a little bit more intuitive, complicated, and like type 1s, type 2s, type 3s. A lot of people are like, I want to like clarificate. Oh yeah, I had a bit of trouble, but type 4s is like more impulsive, where like you might be like, it's like you're taking a overextension on like gold with like a shift, could be like a breakout shift on the XY, or it could be like volume increasing. It could be like, yeah, a push or breakout on DXY. I found like nice entries off of that. It was similar to what I took today, where you kind of like buying when it's kind of extended, sorry, selling when it's extended. I've taken this type of trade all the times at the new 4-hour open. I'll make a video on it soon when I've gotten more data on it, or I've just gotten a little bit better at it, so I can explain it better. But yeah, I will be showing this as well. Do you guys think this looks better or this looks better? The lines or like the shaded one? I might do, it's a bit simpler, but it's just nice for like identifying counter behavior as well. This one? Ooh. Yeah, it's cleaner. Yeah, so before I type one with that 1 minute shift to structure, all this sort of stuff, it'd be, yeah, it's nice to kind of connect those different time frames, all that sort of stuff. Okay. This will show like an exact session timing as well. Makes it easy to, like, a good idea is like to go back and see how price has been moving at certain periods of time, and like adapting to that as well. But yeah, I think that's it. I've kind of covered most of it. Entries, trade management. There's a lot of overlap, a lot of like repetition. Yeah, a really good way to improve is just like set alerts. It's like a lot easier psychologically. If you're trading a longer duration or a larger time frame, larger move of structure, set alerts. Don't constantly be looking at charts. Yeah, that's a really good summary there. Trade market structure, not your account balance. Focus. Yeah, you can always increase risk. It's a lot easier to increase risk than to increase your account balance after you've lost half of it. So start smaller. As well. Okay, nice. I upload this like all the videos. I'm gonna be like adding in a bunch of different things as well. Where is that? I'm trying to make a shareable. Found a potential way to make a shareable, interactive mind map. Fortunately, like this has like pretty similar to like Obsidian. Shareable. You might be able to see this if you like type in that URL, but this doesn't have any of the images yet. But I'm thinking of doing like I might like each one of these would be like a mind map. It'll be like a 3-step process linked to course videos or breakdowns, all that sort of stuff. Be able to visualize the whole trading skill a lot easier. You can embed videos, all that sort of stuff. But that's coming soon. I'm going to be listing these indicators. What else? So this today was a little bit earlier. So all calls are like at 8 p.m. And the weekly recap is now a monthly recap because we're going to do monthly journal reviews, all that sort of stuff. Like increase the delay of that a bit more, as it'll be like kind of better. Because you need enough data to actually be able to make accurate decisions, and I'm going to be kind of putting more into improving the webinar archive, adding more to the course, or like adding more to the guide, making it a little bit more clear and simple, and adding some more things like daily wise. Bit of roadmap milestones for people who've been around a bit longer, like adding in some more stuff. And yeah. Might do some things around like trading journals, like better ways to do feedback, all that sort of stuff. Because like the best learning, as I've always said, maybe some like accountability things, like trying to make it more scientifically better for learning. Because as always, the easiest way is just the quickest way is group discussion, practice by doing, and teaching others. Yes, I've released a course. But I kind of just did it for a bonus because people wanted it. And I tell you, like some of the feedback I get, like the people I know aren't going to become profitable are the ones buying it just for the course and just for the strategy. Like no idea that like it's you become good at something from doing it, not from watching a video. The course should just be a guide. The whole point of the community is actually to learn. The course is just a guide. So yeah. But yeah. So this is gonna be hopefully on a web, or I'm gonna revamp this. Hopefully as clean as Malik's, because he has a really nice mind map, and that's all coming soon as well. But yeah. I'll catch you guys, as always, second half of Asia, posting analysis, direction, areas of interest, all that sort of stuff. Hope you have a good rest of the week. I'll catch you guys next Tuesday. I'll post a poll on Monday, and keep up the good work, as always. Okay, so yeah. Okay, just make sure I'm recording. Okay, nice. So today I'm going to be going over time and price. So market structure, counter behavior, I've gone through that quite a few times. Counter behavior is just market structure but high time frame candles. When you're using different time frames, you're always looking at the same thing, just through kind of like a different lens. I'm going to try to use as many metaphors, allegories, shit like that as well. So we'll start off basic. When you're looking at a chart, you're trading a chart, you have different time frames. You have the daily, weekly, monthly, which is kind of really high time frames. Each candle is a day. And then you go 4 hour, each candle is a 4 hour candle, all that sort of stuff. And then you break it down into, you have different time frames, and then on these different time frames, I look at it as you have candle behavior, so the movement of individual candles throughout the life cycle of a candle. How does a candle move when the previous one has closed bullish, which is more kind of micro in this time frame. Then you have macro, which is market structure. So price action can be broken down into two things: candle behavior and market structure. And this is on every time frame. So it's very complicated, lots of little details. But I'm always looking at candle behavior of the micro individual candles on a time frame, and the macro market structure of that whole time frame. You can always like zoom out and look at this larger time frame structure, where that's like larger time frame market structure. If I go to week, that would be candle behavior. So price is always fractal. I'll get this up. Connecting different time frames. The whole point of this approach is to align different time frames to stack probabilities and confluences in your favor. So what this 15-minute type 1 might look like on low time frame market structure. So you have candle behavior here. On market structure, it'll look like your type 3. So you're connecting candle behavior market structure, using that to connect different time frames to align them. And this might be a little bit confusing because I'm trying to explain my intuition, a gut feeling. Intuition is what you can't necessarily put into words, so it will be a bit different. So ask lots of questions. If you're not sure about certain things, ask me to clarify, as that will also help me out as well. But you have candle behavior market structure across different time frames. Each time frame can be broken down into the micro candle behavior and the macro market structure. There's this structure here that's in context of this larger structure here. You can look at it through the 4-hour candle time frame of market structure, or you can look at it through candle behavior as a weekly type 1. You come to the same conclusion. So type 1 close bearish, pretty strong close here. So that'll be looking kind of bearish. You're looking kind of bearish. Maybe you're looking to take a sell around this level on the weekly. If you're going down to hourly or 4-hourly, you'd be kind of looking for like a sell around there, which would be around a previous low. So candle behavior and market structure, you're looking at the same thing, just through different lenses, micro and macro of each time frame, and always being aware of like it's a move within a move within a move. It's always fractal. What happens on the small time frames? So what happens on the 1 minute happens the exact same way on the 1 hour, the 4 hour, the daily. So this is where trading can get really complex, because is direction bullish? Is it direction bearish? Is it bullish? Well, it might be on one time frame, but it could be bearish on the 1 minute, but in actuality, it's an overall high time frame uptrend. So it might be good to take a sell around here, not so good to take a sell around there. And the tricky thing is that a lot of people get trapped in. This is kind of like when you're taking a sell here, it's kind of like reversal counter trend. It's not too sure. If you're looking for a sell, you're not too sure about this. A lot of new traders or a lot of traders, retail traders, will we'll be looking for buys because it's pretty clearly an uptrend. But when you're like looking for sells here, you're going to get a pretty good trade. But when you're clearly, it's a downtrend now. It's clearly a downtrend. You're looking for sells. You might have entered too late, and it could be a continuation of the uptrend. So you always want to be mindful or aware of higher time frame structure, and that move right there could be just a part of a even higher time frame move down. So it's really tricky connecting different time frames. There's so much complexity there, but I'm going to do my best to try explain my gut feeling. So today in the Discord, I posted low time frame bullish, high time frame bearish. What does that kind of mean? I'll kind of clarify that. So thinking of time frames, this point of time, you're on the 4 hour. Depending on how far you zoom in or out on the 4 hour, most of the time you're talking about a week or a couple of days on the 4 hour chart. So don't look at time frames of just 4 hour candles, 4 hour charts. Look at them as periods of time. I'm not trying to trade a certain move. I'm trying to trade the next 10 minutes. That sort of thing. You're trading a period of time. This is why when I say I exit early when it's ranging or low volume, I don't want to be in a trade for too long because I'm only trading the next 10 minutes. If it doesn't happen, if the move doesn't happen how I want it to in the next 10 minutes, that's no longer a part of my edge. So you're not just looking about where price action is, you're looking about when it is. So when are we in the daily candle? When are we in the 4-hour candle? So it makes it a little bit more complex. You're always looking about, so where are you in market structure wise? Could be also candle behavior. But when are you in the day? So first half, creating that daily top wick to have a bit of a shift, push. Or when are you in the 4-hour candle? Are you in the second half or the first half as well? So I used to think about where you should just purely look at price action, and I used to get stopped out a lot and not understanding all this sort of stuff. But that's just because I didn't understand when. If we just remember, the markets are made up of people. Yes, you have like